Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
What about a debit spread? Let's look at this SFC, Swiss franc index here. SFC is at 88.62. Let's say we think it's going a little higher. We'll buy the 88.5, 889 call spread. 20 bid at 32. I bet we could middle that market. Buy 2 cents lower than the offer. We'll cheat a little bit. Pay 30 cents. Now, with the debit spread, the most I can lose is what I paid for it, i.e. 30 cents. Most I can make is the distance between the two strikes, or 0.5 minus 0.3 is 0.2, 20 cents. If I look at a P&L diagram, I have something that looks like this. Now, let's back up a second. SFC is at 88.62. Look, this is still a reasonably high probability trade. The price kind of lives like right around here. To lose the maximum amount, it actually has to fall a little bit. I'm using a slightly in the money call that I'm buying here. I'm selling an out of the money call. But really, to have this trade really work out for me, this currency needs to rise. Not necessarily a lot, but a little. Ideally, I want it to be above 89 by expiration. Okay, so I gave you your crash course. I gave you your analysis tips. I went over a couple examples. Debit spreads and credit spreads, they seem to be very different animals. One I pay for, one I collect money for. One, I need to go higher. One doesn't need to go anywhere. It could just sit where it is. These seem to be very, very different. Well, remember I kind of gave you the punchline a little bit? They're actually the same. That's because calls and puts are actually the same. A long call and a long put are the same thing. With a caveat. The caveat is that you add, well, I'm saying stock here, but, the underlying to the mix. They're synthetic relationships that exist. A long call is the same as a long put with long stock, or being along the underlying. Short call equals short put plus short stock. Long put equals long call plus short stock, and a short put equals short call plus long stock. So, how exactly does that work? Well, if you've ever looked at a P&L diagram of a long call, picture what that looks like. Kind of like a hockey stick, right? And if you've ever looked at a P&L diagram of a married put, long stock plus long put, guess what? It looks exactly like a long call P&L diagram. Why? Because it's synthetically the same thing. You have limited loss and unlimited upside. Once you factor in interest and if it is a stock, dividends, a long call and a long put is the same thing once you add stock to the mix. So if that's true for individual options, it must be true for spreads. And in fact, it is. And really, the fact of the matter is we don't actually have to add the underlying to the mix to make this work. Now, in blue, and let's start with the underlying in the mix. Let's say I'm long a 260 call and I sell 100 shares. Now, per my last screen, synthetically, that means I'm long 1 260 put. Because long call plus short stock equals long put. If I'm short a 280 call and I buy 100 shares, that's the same as being short a 280 put. Short call plus long stock equals short put. So, okay, so if I buy a call spread and I hedge both legs with shares, it's the same as buying a put spread. And in fact, I don't really need to make the stock trade because I'm just selling 100 and buying 100. They cancel each other out. So really, if I buy the 260, 280 call spread, it's just like selling the 280, 260 put spread. Synthetically, it's exactly the same thing. So what I'm saying here is a debit call spread is synthetically exactly the same thing as a credit put spread. Now I've got some questions that rolled in here, and we've got to have a hard stop here in 10 minutes or so. But I'm going to have time, I think, for all the questions. If you have questions on the presentation, you haven't entered them yet, now it's time to type them in. I'm going to get to as many as I can. Really quick, though, I want to tell you about something that I'm extending here to people who are watching this presentation. Every month, I do an online education series, and it's a different theme each month. May just happens to be probably the most important one of all of them. I've never actually done this series before. It's brand new. I'm creating it this month as I go along out of principles that I teach my students. It's called Maximizing Returns and the Probability of Success on Options Positions. We talked about some spreads here that are high probability trades. Why wouldn't you want a high probability trade? Usually you do, although there might be sometimes when it doesn't make sense. It depends on the risk reward. People run into trouble when they put on high probability trades and they don't price them out right. This is a super important online seminar. There's 4 presentations this month. They're all on Thursdays of May. The first one starts in 2 days on May 5th. So you need to sign up for this today. You get all 4 of those presentations, plus I've archived the last 6 months. So I've got presentations on income trades and on a lot of other important topics. So that's a total of 24 more presentations that you can watch whenever you want. Also, you get access to the password protected student section of my website, and you get access to a lot of trading tools, online videos, online tutorials, and much, much more. It's a ton of information, a really great value. This is, I was doing this, as you can see, for a firm that I sometimes do presentations for. But I'm extending this also to ISE webinar attendees. If you watch this webinar, you can have access to my old pricing. My old pricing was $199 a month. I've changed it to only allowing people to order 6 months at a time for $1,000. I can extend that to you as well. But for people who just want to kind of try it out, you get the old pricing here. It's $199. easy sign up. Just simply go to markettaker.com/options_education. You can see the web address right here, markettaker.com/option_education. And you can sign up online with PayPal or credit card. Seating is limited, so please join me in this really, really important series. Now I'm going to go through some of the questions that I've got. And okay. Let me just slide back here. Oh, okay, so Ray had a question earlier, debit spread, why not use in the money to get the best value for the short leg? You were kind of a step ahead of me, Ray. As you can see in my example, I did actually use an in the money option. But on the slide earlier on, I said the traditional, most common use for debit spreads is to trade an at the money or out of the money option, and then sell a higher, and then trade a further out of the money option as short leg. That's the most common way of doing it. Is it always the best way? Well, no, it's very situational. Sometimes you want to do an at the money or out of the money. Sometimes you prefer to do an in the money. when the leg you're buying on a debit spread is in the money, as Ray pointed out, you can typically sell a closer to the money option, thereby bringing in more premium on it. It kind of changes the characteristic of your spread, though. It makes it a higher delta spread typically because you're buying a more in-the-money option, and it's higher delta. And it does have the potential advantage, potential disadvantage of having lower time decay, possibly negative time decay, possibly positive time decay. And same thing with Vega, possibly positive or possibly negative Vega. Ray, when you put on a spread that way, where you buy an in-the-money option, that's where this final bit that I painstakingly went through about the synthetic equivalence, specifically, an in-the-money call debit spread is equal to an out-of-the-money put credit spread. So really, you're putting on a debit spread, but you might be trading it kind of similar to a credit spread. So that kind of opens up a whole bunch of discussion here, but you know, I want to make sure I go through all the questions here. Debit, from Ray again here. Debit spread, you try to get a certain size of delta difference between the two debit and credit spread legs. Certainly, there's not a one-size-fits-all here. That's where people end up in trouble, is trying to make option strategies cookie-cutter techniques. The reason why, you know, there's a billion different debit spreads or a billion different credit spreads that you can construct in an option chain, maybe not a billion, but sometimes there's like 100, is because each one serves a slightly different purpose. Sometimes a really nice high delta spread is just what you're looking for. Get those strikes nice and wide, because really you're trading, you know, maybe you buy a fairly deep in the money call and sell a slightly out of the money call. You'd be trading that kind of like a proxy for a covered call. You know, when you really want that high delta because you have a great degree of confidence that it won't fall much, and you want to start making money right away with the first few ticks and you really need a high delta, Ray, that's when you use an in-the-money option to try and get that big delta. But if you're just kind of being speculative, like you really want to trade just an out-of-the-money call, but you want to hedge off implied volatility risk, maybe because earnings is coming or something, or there's takeover rumors, you know, that's when it makes way more sense to buy an out-of-the-money call and sell it the next strike higher out of the money call to hedge off that time decay or volatility risk. So, there's not one right answer. It depends on the situation. It's situational, and it's not the same answer every time, man. Joe, hey, Joe, how are you? Joe has attended my online education series. A student of mine, Joe P. I don't like to give last names for, privacy reasons. But Joe is asking me, what is the source of the charts that you use? Options pricing charts. Thank you. I'll tell you what, Joe, the people here with ISE can help you out. They've got a really, really excellent currency charting interface on their website, or if I'm not mistaken, it might be your microsite just for currencies, guys. Maybe you can fill people in afterwards. But they've got kind of a one-stop shop that has the price charts for the currencies, as well as, I'm pretty sure you guys have the volatility charts, don't you? So tool around on the ISE website or talk to those guys, and they'd be happy to help you out. Alice says, by looking at the Greeks in a potential trade, I can quickly determine ramifications of delta and theta. However, I have difficulty looking at gamma and vega and quickly seeing their ramifications. Any tips to quickly do so and what I should be looking for? Well, Alice, the short answer is no, I don't have any quick tips. Delta and theta, they are kind of the easy ones. Gamma is sometimes really important, but it's probably the least important of the four. You absolutely, though, need to work on getting better at using vega. Vega measures your implied volatility risk. And, sometimes you want a nice big positive vega. Sometimes you want a nice big negative vega. Sometimes you want to have no vega, and anywhere in the middle. It depends really on whether the options are underpriced or overpriced. And you need to be able to read volatility charts. And again, like I mentioned, I think that you can find the volatility charts for currencies on the ISE's website. So go ahead and check that out. And, the only thing I can tell you is I'm going to be talking about it a lot in my option education series here in May. Buy yourself a call and spend $199 on my month-long series. Plus, I've got some archived online series that discuss just volatility that are going to be really, really useful to you. I could do I have done a whole 4-part series just on volatility and reading volatility charts. So not a short answer, but the gist of it is learn to read volatility charts and then apply vega to get edge. Really, really important. Ray says, put call parity. Does the sign bit change for the interest and dividends for short stock? Yes. Basically, put call parity is one long algebra equation. And you might have to kind of think back to your high school algebra. I bet a lot of you guys would be able to do it pretty easily. Some people might actually need a little Wikipedia action to figure it out. But use put call parity as an algebra equation, and then you can figure out how to change the signs yourself. Let's see here. Steve says, do you cover selling out of money iron condor trades as well? Yeah, you know what, Steve? In the archive series that I did last month, I spent a lot of time on talking about out of the money iron condor trades. You'll get access to that when you sign up for the class. And the month before that was all on adjustments. So you'll get a 4 or 5 hour tutorial on adjusting as well. Adele asks, how how does the volatility affect a deep in the money spread? Great question. Deep in the money spreads are traded just as well. A deep in the money call spread is traded exactly the same as an out of the money put spread because they're synthetically identical. And here's the gist, and this kind of touches a little bit on whose question was that? Oh, Alice's question. This kind of is in the same vein as Alice's question, and I hope this answers her question a little more, because I didn't know how much time I'd have to give her on that one. The gist is, if options are overpriced, and there's an art to knowing if options are overpriced. There's not like if this line's here, then it's overpriced. It's not really how it works. If options are overpriced, you want negative vega. If options are underpriced, you want positive vega. That helps you determine whether you should be doing an in-the-money spread or an out-of-the-money spread, credit spread or debit spread. So you need to seek to construct a spread that helps you gain volatility edge through your vega by exploiting underpriced or overpriced options. That's kind of really the gist of what this whole next month series is all about. And Ray, you are welcome. Thank you for attending. And it looks like that is all our questions, and that is all the time we have. So thank you everyone for attending, and really, please go to this web address and check out all the information on this coming series. I think you're really going to like it, and it's helpful for everyone. If you're brand new to options, or if you've been trading for 20 years, this is for you, because I take my market maker experiences and apply them to retail traders and teach you how to exploit how market makers think, really. So go ahead and visit that website. You can learn more about it, and send me an email if you have further questions after that. Everyone, thank you for attending. Have a great afternoon.
And thank you, Dan. This is ISE. Just wanted to jump in and thank you for sharing your insights today. I know that everybody appreciated it and learned a lot. Just want to also thank everybody else for joining us. And as Dan said, if you visit ISE.com or FXoptions.com, you can learn more about ISE FX Options. Also on FXoptions.com, you'll be able to see a full list of our available currency pairs, plus have access to other educational resources. You can sign up for free trade alerts with timely recommendations based on what's going on in the FX market as well. We also hope to see you on upcoming webinars. You can sign up at ise.com/webinars. You can see our latest schedule there of upcoming events. This presentation will also be archived at ise.com/archives within the next few days. You can also browse through our other archived webinars as well. Thanks again, and we'll hope to see you all next week. Thanks, Dan. Bye-bye.
Thank you. Bye.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.